Hi, I'm Jeff Holt, analyst with Morningstar Manager Research. And today I'm joined by Ann Lester, Global Head of Retirement Solutions and Portfolio Manager for JP Morgan Asset Management. And today we are here to discuss JP Morgan Income Builder, one of the strategies that she co-manages. And based on its holding, JP Morgan Income Builder falls in the conservative allocation category. But as the name alludes to, it has a very distinct objective. Can you describe that objective and how you strive to meet that objective?
Sure. Well, our first objective is generating yield, and we have a very diversified sort of overall pool of things to pick from, but we really try to keep the overall risk of the portfolio in line with the 60-40 stock bond portfolio or lower, but sort of beyond that, go anywhere in an effort to try to maximize the yield we can find, always keeping that risk budget in mind.
Okay, and your portfolio can hold a lot of equities. It's hold as much as 50% in equities. Right now it's around 40% in equities. One area that you found within equities has been European equities. In particular, you've had a dedicated sleeve to that area. What's driving that interest in European equities?
So we believe that Europe is several years behind the U.S. in terms of its economic recovery out of the financial crisis. The ECB is still aggressively doing QE, and we've obviously stopped that and are now on the path, we think, this year, probably, to raising interest rates. So from a sort of valuation perspective, we think that Europe is an attractive market. From a growth perspective, we think Europe is attractive. And very importantly, from a broad sort of market characteristic, European stocks have always historically paid higher dividends than the U.S. market does. And that those dividends are more broadly diversified by sector than the U.S. So in U.S. stocks, if you want a yield portfolio, you're really stuck in a couple of sectors. In Europe, you can get very diversified. Those are all reasons we like the market. And then in particular, we really like the PM on the strategy that we're using. He's just done a terrific job and has a great sort of eye for yield, but also growth. So we're getting a great set of ideas from him in the portfolio.
And jumping over to the fixed income side, you have a lot of flexibility to move in different asset classes. In fixed income, your portfolio is held as much as 50% in high yield bonds. 55% in high yield bonds. But that allocation has come down to an all-time low since the inception of the portfolio, since 2007.
Yep.
Around 20% in high yield bonds.
20, closer to 25 right now.
25% in high yield bonds. What drove the decrease in the bond allocation?
It isn't that we don't like high yield. It's like we like equities more. So we had 55% in end of 08, beginning of 09, coming out of the financial crisis, getting both amazing yields and amazing total returns. Right now, we think we'll get similar yields, frankly, from a lot of our equities that we do from high yield, or sort of barely more in high yield, and we know there isn't going to be any real upside from a total return perspective anymore. So we don't think the market is over. We don't think there's a big sell-off. We don't see a recession on the horizon, which is one of the many things that causes high yield to sell off. We like the market, but we like equities more, is really the bottom line. But in a fund that says income in the name, barring any real reason to hate the asset class, it's likely that we'll always own some.
You don't just own bonds, equities, and bonds. You also have some esoteric asset classes. You include REITs and you include preferred stocks. And preferred stocks is one of those that you've gotten up to a 10% allocation in preferred stocks. What's the benefit of owning preferred stocks in an income portfolio? For
starters, they're great yielders. They're fixed income-like securities. They pay a much higher dividend than the straight-up equity would. But they're also primarily issued by U.S. companies. And one of our thematic bets in the portfolio right now is an overweight to the U.S., and we like that in all of our asset allocation strategies that we run. But if you're an income portfolio, the U.S. equity market is kind of a lousy place to be because yields are so low. And as I said earlier, to get any yield, you've got to go into sectors that we think are not terribly attractively valued. So preferreds, a lot of U.S. financial stocks or financial securities in the preferred space, we think let us both play the U.S. recovery, play where we are in the interest rate cycle, and also give us a significantly higher yield than just about anything else in the portfolio, so 6-7% yields there. So it's attractive on just about every front from our perspective.
You have the flexibility to move across all these different asset classes, stocks, bonds, and some unique asset classes. And what should investors expect from a risk-return standpoint for this type of strategy?
It's not going to be, we think, it's not going to feel as good going forward as it did looking backwards. And, maybe some people listening to this are going to say it doesn't feel very good right now. But we do think we've actually, if you look back over the last couple of years, had double-digit returns and single-digit volatility. And that's not normal, actually. That's abnormal, right? And we think going forward, we're going to be seeing single-digit returns and double-digit volatility. And in an environment where even if the Fed starts raising rates, we're not going back to normal for a long time, and we do think the new normal will be a bit lower, right? A 4 to 5% yield we think is achievable, but not much more than that, and you're going to have to own some risk to get there, right? So that trade-off is going to feel a little less comfortable than it has been. I think the market has probably gotten a little complacent about the level of volatility. Again, we're not by any stretch predicting a big sell-off like '08, but we do think normal market corrections are going to be something we see, especially when the Fed does raise rates. Again, nothing to knock our view that is constructive on risk assets, not to make us rethink that thesis, but some more choppiness in the market we think we'll experience.
All right, well, Ann, thanks for joining us today.
Thank you very much.
I'm Jeff Holt from Morningstar. Thanks for watching.